So what I'm just saying is that we are starting from where we left from our previous video. And mostly we were discussing about the portfolio theory and analysis. And I remember last time we were looking on the introductory part and how can I be able to maximize my investment? How can I be able to combine my securities with an objective of maximizing my returns and be able to minimize the risk? But when you look on the concepts, it means that in any investment, and that is why I was giving an example of these relationships. I was saying that there must be a risk which is expected to be there. And remember, you are combining your efforts, right? And there must be a risk which is going to be involved based on, I don't know anyone. This is a new person to me, but I'm going to be giving a chance, right? So that one is a risk which you're going to be using. You're going to be undertaking, and therefore there must be a concept of the portfolio returns. And I talked about the portfolio is going to be made up of two people here, the wife and husband. So what will be the return of the portfolio? One might be the faithfulness, and also we look on I talked about the small people who are going to be calling you dad and mom. Now, in that case, when it comes to the concept of investment concepts, we have to be looking on people normally tend to, why are we not all in the same bank? Because of the decisions which we normally undertake, and what do we want to achieve? And basically because those are the things that we have to be checking on when we are doing our investments. It means that we are not going to be putting our investments in one bracket. No, we are going to be diversifying our risks, and that is very crucial because it is not going to be putting yourself, or it is not going to be putting the organization in a portfolio risk. And in this case, we are saying that if, for example, I'm going to be keeping some money in bank A, and then I'm going to be putting another money in I'm going to be putting in where am I going to be putting in Sacco B? What will be the return of my investment? We say we have to be looking on the risk which are being involved. For those people who are now investing with the bank, I could be able to see today the banks being able to inform its members that it is being able, but a minute, please. Be affecting, which are going to be affecting us directly. For example, now when we look on the concept of the VAT filing now, is going to be one of the difficult thing ever. It is going to be a challenging one. So, considering what the proposals the government have already undertaken, the businesses are going to be cornered. But that being said and done, we have to move on. So in this case, we are saying that when you look on the portfolios, I was able to teach you about the return of the portfolios. And we said, if we want to get the return of the portfolio, we have to be combining two assets. We have to be looking on the asset A and what is the return of that asset. That is asset A again. Then secondly, we are talking about how am I going to be getting the expected? Because when you look on the investment concepts, we normally argue about the issues regarding to the return of the expected return of the portfolio. And this expected return of the portfolio is basically based on the stories which are being given by those banks, based on the two types of, based on the risk which are basically faced by investments. And I said very well that because we want to know what is the expected return of the portfolio, we are going to be taking the weights of a certain assets, we multiply by the expected return, then we combine with the other investments which we have already been doing. So we say to get the expected return, we normally take the summations of a return of a certain asset. Let me talk about asset A, then we multiply by the probabilities. Let me just be able to do a recap here on our boards so that we can be able to understand what I mean. I hope everyone now is ready for the class, because there's so much fun. We have to do all the questions regarding to we are going to be doing all the questions regarding this topic, and I'm sure we are going to be finishing tonight. We are going to be finishing this topic, a major part of it, not all of it. It cannot end today. So let us just get ready. We now start the computations. I remember now, when I was analyzing all these, I told you that when you are going to be looking on the portfolio return, which we are saying it is the weighted, what am I going to be doing? I said this, if you need to get the returns, the expected return of the portfolios, if you need to be getting the expected return of the portfolios, we have said we normally take the weights, we multiply by the expected return plus the weights of a certain. Let me just take my barrel so that I can be able to show you this. So let us move on. We said to be able to get the expected return of the portfolio, what am I going to be taking? I said we normally take the weight of a certain asset, because we said we normally combine two assets, right? We normally combine two investments. And now I'm going to be using A and B. Sometimes it might be X and Y, P and Q. It is not a must should be A and B. So we normally take the weight of A times the expected return of A plus weight of B times the expected return of B, right? And I said very well, to be able to get this expected return of A, I'm going to be taking the summation of A times probabilities plus the probabilities, right? And we say very well, if there is an absence, if there is an absence of probabilities, we say if these probabilities are not in existence, to get the expected return of asset A, you're going to be taking the summation of return A, you divide by n minus 1. And in this case, we said, right, in case of we are going to be measuring the sample sizes. And here you can be able to note and say, if the sample size is less than 30, if the sample size is less than, right? What if the sample size is greater than 30 now? If the sample size is greater than 30, we normally say the expected return of A, we divide by n. But we said, right, in this case, we said, to measure the portfolio risk, to measure the portfolio risk, we normally use standard deviation and coefficient of variation, right? And we normally say again here, the higher the standard deviation, or coefficient of variation, the higher the risk. The higher the risk, right? And in this case, because we are saying that we are going to be measuring our risk, the portfolio risk using the standard deviation. So you need to understand that to get the standard deviation of the portfolio, you normally take the root of your variance. This we are calling it the standard deviation of the portfolio. Ask yourself, this variance is not always squared. That is the sign of variance, correct? And now if we want to get the variance here, if we get the variance, right? If we want to get the variance of our portfolio, we normally say, can we be able to take a lot of, we take a root of what? We normally talk about the weight of A. squared times the variance of A plus weight of B squared times the variance of B plus 2 weight of A, weight of B, right? Then we multiply by the covariance of A and B. We multiply by the covariance of A and B, right? And in this case, I remember I said very well, if we want to get the variance, I remember there before we used to say, to get a variance, for example, for A, we used to talk about taking a root of the summation of x minus x bar squared. We multiply it by probabilities. And this is what we are eliminating now. Because we are not dealing with x's, we are dealing with returns. What normally happens here, you normally replace, we talk about a return minus the expected return of, for example, for A. That is how we are going to be getting the variance of A. Now we are not going to be talking about x minus x bar. And we know very well, in case of the absence of these probabilities, we are going to be dealing with the sample sizes. We are going to be playing with the sample sizes. So there is no any problem in regards to that. If the sample size, for example, is less than 30, we are going to be dividing here by n minus 1. And if, for example, we are discussing of it is greater than 30, we divide by n. Then we remove it. It means that the probability is not in existence. The probability is not in existence there. The other thing that I just want to elaborate here, because I just want to do a lot of questions here. I just want us to talk about the covariance. And we know very well, when we look on the measuring, for example, when we are measuring, right, we are talking about measuring the relationship, measuring the relationship. When we are measuring our relationship, when we are measuring a relationship between the security returns, right? When you are measuring the relationship between the security returns, and I will be able to take you back, we normally use, right? We normally use the covariance. We normally use the covariance, and also we normally use the coefficient of correlation. The coefficient of correlation. When you are measuring the relationship between the security returns. I just want to start with the first one, where we are talking about covariance, which is basically used to get the is part of what we are using to get the standard deviation of the portfolio. And we are saying that if, for example, we want to calculate the covariance, because the covariance between the two security returns indicates whether there is a positive or negative relationship, but it does not give the extent, right? It's just going to be telling us whether there is a positive or negative relationship between the two securities, but it is not going to be telling us to what extent. Now, in that regard here, we say, right, in this case, we say the covariance is normally computed as follows. Covariance is normally computed as follows. How do you normally compute our covariance? We say when we are combining two securities, like what we have seen here, we say if I want to get the covariance of A and B, if you want to get the covariance of A and B, we normally take, for example, we talk about the summations of a return of A minus the expected return of A. Right? You open the second bracket, we talk about the return of B minus the expected return of B. Then we multiply by the probabilities. But if this probability is not in existence, we normally talk about the use of the sample sizes. It means that if I want to get the covariance of A and B, I'm going to be taking the return of A minus the expected return of A, right? The return of B minus the expected return of B. Then we divide by n minus 1. If the sample size is less than what? Than 30. And if the other case applies, then we are going to be divided by n. Now, number 2, we need to be understanding very well, and this is the question which is going to be coming in those exams of yours. The examiner is going to be asking us about, and these formulas are very important. this formula. I just want to take around 30 minutes to do a recap. Then we do a lot of questions. And then here I'm saying, for example, if number 2, we want to do the correlation coefficient, or coefficient of correlation, right? You can call it whatever you want. And we say that it normally indicates the extent of the relationship between the security returns. And how do we normally calculate the correlation coefficient? It's normally written like this. So it means if I want to get the correlation of A and B, for example, if I want to get the correlation of A and B, then it means I can be able to take, and sometimes the examiner normally gives the correlations. So in this case, if we want to get the covariance of A and B, I will be able to show you how you can work it out. You divide by the standard deviation of A times the standard deviation of B. These are the standard deviations. These are standard deviation. These are covariance between the two securities. That is a covariance. That is a covariance. That is how you're supposed to be calculating it. Now, from that, it is very important to understand that the examiner is going to be asking you this question, right? The examiner is going to be asking this question. The examiner might be asking you the percentage of risk diversification. The diversification. And if, for example, you want to get the percentage of the risk diversification, you normally take the weighted. We normally take the weighted standard deviation of the portfolio minus the actual standard deviation of the portfolio. You divide it by the weighted. Standard deviation of the portfolio times 100%, times 100%, times 100%. There is another concept which I discussed about it here. We discussed about the decision making, as I could be able to hear some of us discussing about it. And the decision making basically is going to be teaching us how can I be able to make these decisions, right? To differentiate whether I'm supposed to be, I'm going to be investing on a given given asset or not. That is why we are talking about the decision making. And we said very well, we normally compare the expected return of the portfolio with the capital market line, right? So in decision making, we said we normally compare. We have said we normally compare the expected return of the portfolio, and the capital market line. We normally compare between the two. And we say if the expected return is higher than the capital market line, the portfolio is good since it is super efficient. It is since it is super efficient or undervalued, right? But we say in decision making here, right? In decision making, because we have said we normally compare between the two. This is what normally happens. If we normally compare between the two, this is what we're going to be doing. We normally say, right, under the decision criteria, let me talk about under the decision criteria, right? Under the decision criteria, we are saying if the expected return of the portfolio is greater than the capital market line, we say, right? We say the portfolio is good. The portfolio is good since it is undervalued, or you can talk about super efficient. Secondly, if the expected return of the portfolio is less than the capital market line, what can we talk about it here? If the expected return of the portfolio is less than the capital market line, the portfolio is bad. The portfolio is bad. The portfolio is bad since the portfolio is bad since it is inferior. Since it is inferior. Since it is inferior, or we can talk about overvalued. We discussed about these things. Then, if the expected return of the portfolio is equal to the capital market line, what do we normally say? We say the portfolio is correctly valued. The portfolio is correctly valued. The portfolio is correctly valued. To be able to understand all these concepts, I just want us to do a lot of illustrations. And one of the illustrations, even I'm not going to be taking it from the past paper. It is mine, which I will be able to write down here, so that we can be able to understand all these criteria. And how can I be able to apply these formulas in an exam? So let us start by looking on my illustration here. Let us do it right now. And if I'm fast, by the way, you tell me. If I'm fast, let me just know. If I'm fast, let me just know. These are the things that we discussed last time. And if, in the morning, I talked about us trying to do what? I said we should be watching the video, which we did. But here we can be able to say, let us do our illustration here. Right? I want us to do, or to base our arguments. We say, Bet Moye has invested 75%. Has invested 75% of our funds in shares, right? In shares of a company X. And 25% in shares in company Y. In company Y. And we are being told the following probability distribution relate to the shares of the two companies. Relates to the shares of the two companies. Relates to the shares of the two companies. Correct. So here we are going to be having the state of the economy. You know, you can be able to tell ours is bad. Then here we have probabilities. Then here we can discuss about the return on company of company X in percentages. And here we can talk about the return of company Y in percentage. Okay. Here we are saying we normally have boom. You can have steady growth. Then the other one you can talk about slump. Right? But on the other side, the probabilities provided here 0.6, 0.6, 0.2. Then the return, here we have 24, 12. Then the other side, we have 5. We have 30, -5. Required now. Required number 1. Required number 1. We are being told, can we be able to calculate the expected return, right? we calculate the expected return. The expected return on the shares of the companies, on the shares of the company X and Y, right? And in this case here, it is very simple. You just need to tell this examiner, right, that to get the expected return of a given portfolio, we normally take, what are we going to be taking? We are going to be taking the returns we multiply by, right? The returns we multiply by the probabilities. So in this case, it means if I want to get the expected return of X, I'm just going to be taking 24 times 0.2 plus 12 times 0.6 plus 0 times 0.2. Then we go to the expected return of Y, which will be equal to 5. You multiply by 0.2 plus 30. You multiply it by 0.6 plus negative 5 times 0.2. What is our answer? That is how simple it is. So if I want to get these expected returns, so let me start with the first one. 24 times 0.2 plus 12 times 0.6 plus 0 times, that will be 0. So here it will be 12%. Now what about the other one? It will be 5 times 0.2 plus 30 times 0.6 plus negative 5 times 0.2. I'm getting 18% here. Correct. That is how you normally get the expected returns. It is very simple. Now, let us look on the other concept here. The examiner might be asking us to compute the standard deviation, number 2. The examiner might be asking the standard deviation of returns, the standard deviation of the returns, the standard deviation of the returns on shares of company X and Y. Correct. And in this case, we will be able to tell this examiner. By the way, we know very well that to get our standard deviation, we need to take the root of our variance, right? And how do we normally get our variance? We tell our examiner to get the variance, for example, for X, I'm going to be taking a return minus expected return squared. Then I multiply by the probability if they are in existence. Now, what is the return here? You can see the returns are being provided here, and you have gotten the expected returns. So in this case, it will be, for example, for X, it will be 24 minus the expected, which is 12 squared. We multiply by the probability of 0.2. We will be able to get our answer there. The second one will be 12 minus 12 squared times 0.6. This I know it is equal to 0. Then the last one will be 0 minus 12 squared. We multiply by 0.2, right? We'll be also able to get our answer, and then we look on the summation. So let me start with the first one, which will be 144, because 24 minus 12 is 12. Squared 144 times 0.2, getting 28.8. And what is the difference with this? They are going to be the same because this is 144 again. So here it is 28.8. Total ni ngapi? Times 2 from my calculator. Getting 57.6. Now, what is the root of our answer here? 57.6. We get the root of your answer will be equal to 7.59. Now, you can be able to do for Y. How much for Y? You can be able to see the returns are here. So the first one will be 5 minus 18 squared times 0.2. The other one will be 30 minus 18 squared times 0.6. Then the last one will be negative 5 minus 18 squared times 0.2. How much are we getting here? How much are we getting there? So the first one will be 5 minus 18 squared times 0.2. Getting 33.8. The second one will be 30 minus 18. Getting 12 squared, 144 times 0.6. getting 86.4. Then the other one will be -5 minus 18 squared. We multiply by 0.2, getting 105.8. So what is the summation? Plus 86.4 plus 33.8. We are getting 226. So what is the answer here? The root of your answer is our standard deviation, 226, right? The root of your answer, getting 15.03. 15.03. That is how you normally calculate your standard deviations. That is how you normally calculate your standard deviations. That is the root we normally use. Now, the next one, the examiner might be asking us to calculate the expected return of the portfolio, right? The expected return, the expected number 4. No. Let us go to number 3. The examiner here might be asking you, calculate the correlation coefficients. Correlation coefficients. Unakuja hapo unaambia examiner, I know what you are asking. To get the correlation coefficients between X and Y, we are going to be taking what? I'm going to be taking the covariance of A and B. Sorry, the covariance of X and Y. You divide by the standard deviation of X times the standard deviation of Y. So let us start by looking on the covariances. And when you understand these concepts, you'll be fine. They are very simple. If I pick this data the way it is without the squared and these probabilities, for example, it will be, because we know how do we normally get the covariance of X and Y, it will be a return of X minus the expected return of X, right? A return of Y minus expected return of Y. Then we multiply by the probability. Multiply by the probability. Right? We multiply by the probability there. So in this case, it means I'm just going to be copying this the way it is. So the first one will be 24 minus 12. The other one will be, this is the first one, 5 minus 18. Then we multiply by 0.2. The second one will be 12 minus 12. We multiply it with 30 minus 18. Multiply by 0.6. Then the third one will be, right, 0 minus 12. Then the other one will be how much? 0 minus 12. The other one will be -5 minus 18 times 0.2. That is how easy it is to get the covariances between the securities. How much? Because we are looking for the relationship, this is not tough. So this one you cannot be able to put it directly on the calculator. We can just be able to look on it directly. 24 minus 12, you get 12. Then 5 minus 18, getting -13. Then we multiply now, times 12, times 0.2. The relationship here is negative, minus 31.2. Then this is 0, and all of this will be 0, right? Then this is -12. How much about this? -5 minus 18. -23 times -12. Getting 276. If you add that 1 minus 2, that 1.2, you're going here to be getting 244.8. 244.8, correct? That is the covariance here. So it means to get the correlation of X and Y, I'm going to be taking the covariance of mine, 244.8. We divide it by the standard deviations. I can see the first one was 7.59. If you can confirm your answers, times 15.03. How much it is? How much it is? How much it is? Catherine, are we together? Catherine?
Yes, Malik, we're together. Yes, yes.
Thank you. So if you divide 244.8 by your with this one, right? 7.59 times 15.03. Okay, we should be getting 2.15. 2.15. What is the other requirement an examiner can try to trick us with this information? It is very simple. If the examiner is asking you about the expected portfolio return, right? The expected portfolio return. So in this case, it means, let me just clear where. So we have this data now. So you allow me just to clear the question itself, of which there is an information there. Remember that this lady was investing certain money. What will be the weights? So to be able to understand this question very well, because the examiner is asking, I don't know which number is this. It should be number 4. Is asking the expected portfolio return. And we say to get the expected return of the portfolio, we are going to be taking the expected return of X. Right? We multiply by the weight of X plus the weight of Y times the expected return of Y. So in this case, remember, right? Let me start with the weight because that is how you can be able to understand. When you look on her, she was able to invest 0.75, right? On the shares of X times the expected return. How much is the expected return of X? Which is 12. Plus the weight of Y, which was 0.25, times the expected return of Y. Okay, the expected return of Y, which is 18. How much is this? Which is 18. So he's in Ngapi. So 0.75 times 12 plus 0.25 times 18. We are getting 13.5. 13.5. I know that one, this is in percentage, sorry. 13.5. 13.5. The other question this examiner can ask is very simple. Can you be able to get the portfolio risk? Now, these are the questions. And we are saying that if I want to get the standard deviation of the portfolio, we say I'm going to be taking the root of the weight squared of X. We multiply by the variance of X plus weight of Y squared times the variance of Y plus 2 weight of X, weight of Y. Correct. Then we multiply by covariance of X and Y. Very simple. The weights, we have them. Very simple, yeah? The weights we are having 0.75 squared times. What is our variance in the question? Or let us, the variance you have it, which is 57.6. Ama you can take the standard deviation, which we have here, you square. You're going to be getting this. Plus, right? The weight of Y, which is 0.25 squared, times. What is the variance for the other one, which is 226? Plus 2 times 57.6, the weight, 0.75 times 0.25 times. What is the covariance now? What is the covariance here? The covariance we got 244.8. The covariance was somewhere here. So can we be able to get this answer? Can we be able to get this answer? And I say it's very simple. Right? How did I came to 244? Okay. 0 minus 12. Okay. I think it is okay from our first, all the data which we have been having. There we are dealing with -5. I think it is okay, all good. It's working well. Now in this case, let us just put this on our calculator. 0.75 squared times 57.6 plus 0.25 squared times 226, right? Plus 2 times 0.75 times 0.25 times 244.8. Then the root of this answer, we are going to be getting 11 points. We're going to be getting 11.76. That is our standard deviation. 11.76. 11.76. Now, from there, let me just teach you the last thing that we have learned today regarding to weights, right? Regarding to the last requirement which the examiner might be asking. The examiner might be asking you, the percentage of risk diversification. The percentage of risk diversification. So to get this percentage, you just need to be able to tell me, Mwalimu, to get the percentage, we are going to be taking the weighted standard, the standard deviation of the portfolio, right? Minus the actual standard deviation of the portfolio. We divide it by the weighted standard deviation of the portfolio times 100%. So how am I going to be getting the weighted? I tell you, if you want to get the weighted standard deviation of the portfolio, you normally take the weight of X times the standard deviation of X plus the weight of Y times the standard deviation of Y. So the weight of X was 0.75. We multiply by how much of the standard deviation of X was around 7.59. I think it is, I can be able to see it here. Plus the other weight was 0.25 times the standard deviation of it was 15.03. How much are we getting here? How much are we getting? How much are you getting there? So if you need the answer, we can just be able to take our calculators and multiply 59 plus 0.25 times 15.03, getting 9.45. And in this case, it means I'm going to be taking 9.45, right? 9.45 minus 11.76. We divide it by 9.45, then you multiply by 100%. So it will be 9.45 minus 11.76 divided by 9.45 times 100, getting around negative 24 points. Let me talk about 4%. This is just an example, right? It's just an example. It's just an example. I just wanted us to understand how and how can we be able to work on this? How can we be able to work on this? Now, to discuss about the issues of the capital market line and so on, it is very okay now if I shift my gears to do some illustrations which were tested in the past paper. And for better understanding, you'll be able to allow me to do a question which was already tested on. I'll be able to start with a question on, let me see the simplest one. The simplest one is on, let me start with November 2019. Let me start from there. On our last video, did we try to do a question from the past paper? Hello? From our last video.
Yeah, we did August 2022, question 1B.
Right, thank you. Okay. So we are doing November 2019, question 3B, because I saw we were not able to understand the concept. That is why I was able to repeat the whole of it. Let someone read this one. We did August 2022 question 1, right? Which question did we do? April or August? Someone to enlighten me.
August 2022, question 1B.
August 2022, question 1B. Thank you. Okay. So let us proceed. Now I know what we are supposed to do. Okay. Someone to read.
Duncan Kipchumba has an investment capital of 1 million. He wishes to invest the fund into securities X and Y in the following proportion. Kenya shillings 200,000 in security X and Kenya shillings 800,000 in security Y. The return on these two securities depend on the state of the economy as shown below. State of the economy, probability, returns on security X, returns on security Y. Boom, 0.4 probability, returns on security X 18%, returns on security Y 24%. Normal, probability 0.5, return.
Thank you. I think those are the only requirements in the question. Okay, we have the portfolio risk, and then we are being told about the reduction in the risk due to portfolio diversification. Now, this question is not different from what we have done, but let me just take you through the question. Because what the examiner here is asking is about, sorry, if I'm breaking. So here we are discussing about to calculate, right? You need to be able to calculate the requirements of the question. So we are doing April 2020, November 2019, okay. So we are doing November 2019, question number 3B. Thank you, okay. Now, this question is very simple because we are being given the returns on security X and Y, and then we are being given the amount of capital which you want to invest and how much you want to invest on specific companies. And in that regard, it is very simple for us to be able to understand what is being required. And how can I be able to get my weights? Correct. So in this case, this question will be easy for us. Let us do it. Let us work on it very quickly. This is November 2019. Question number 3B. And when you look on this question, the examiner is asking about a very simple concept. He's asking you what? The first requirement is asking you about the expected return of the portfolio. And we tell the examiner we understand what we are doing. Why? Because to get the return, the expected return of these two portfolios,
Excuse me, sir, I can't hear you from my side.
hello?
Yes, you are fine now.
Okay. I was saying, if you want to get the expected return of the portfolio, we're just going to be taking the weight of X times the expected return of X plus the weight of Y times expected return of Y. And I said, we can start by looking on the weights. And I said, you can be able to get it in a very simple way by looking on how much does this investor investing on the company X. And you can see he's trying to invest 200,000. So I just be able to take 200,000, I divide by the total, which is 1 million, getting 0.2. Then the weight of Y will be how much? 800,000. You divide it by 1 million, getting 0.8. Already we are done with the weights. Now, when we go to the expected return here, expected return of X, we are going to be taking, to get the expected, we said, can I be able to take the return of X, we multiply by the probabilities, and I can talk about the summation, if they are many. And in this case, we can be able to see certain returns for X. We have 18 times 0.4 plus, the other one is 14 times 0.5 plus, the other one will be 12 times 0.1. So how much am I getting there? And also you look on the expected return of Y, right? So the expected return of Y will be 24 times 0.4 plus, the other one will be 22 times 0.5 plus, the other one will be 21 times 0.1. 21 times 0.1. How much it is? So let me start with the first one. 18 times 0.4 plus 14 times 0.5 plus 12 times 0.1. I'm getting 15.4%. 15.4%. The other one will be 24 times 0.4 plus 22 times 0.5 plus 21 times 0.1. I don't know why I'm losing you guys. So in this case, I was just doing the computations here, right? And in that case, I'm saying that to get the expected returns, we normally take the summation of the returns we multiply by the probabilities. And that is what we are doing right now. So in this case, I have just said, right? When you take the summation, you just need to multiply. And this is what you are getting when you multiply. So to get the expected return of the portfolio, right? What am I going to be taking? I'm going to be taking the weights. So the weight of X is 0.2 times 15.4 plus the weight of Y, which is 0.8 times 22.7. How much it is? 0.2 times 15.4 plus 0.8 times 22.7, getting 21.24. 21.24%. The next question I can see there, the examiner is asking you about the correlation coefficient, right? Number 2, correlation coefficient. So how do we normally get the correlation coefficients? It is very simple. To get our correlation coefficient, we normally take what? To get the correlation coefficient between X and Y, we are going to be taking the covariance of X and Y. We divide by the standard deviation of X times the standard deviation of Y. That is what we said. That is what we said. And in that case, we said, can we be able to get the covariances? The covariance of X and Y. We said in our formula, we're going to be taking the return of X minus the expected return of X, right? The return of Y minus the expected return of Y, then we multiply by the probability. Now, what is the return of X? When you look on the question, the return of X, I can be able to borrow from this information we have here. The first one will be 18 minus 15.4. The other one will be 24 minus 22.7. Then we multiply by the first probability, which is 0.4. The second one will be, right? The second one will be 14 minus 15.4. The other one will be 22 minus 22.7. We multiply by 0.5. Then the last one will be, 12 minus 15.4. Then we have 21 minus 22.7 multiplied by 0.1. Very simple. So can we be able to use our calculator as well? 18 minus 15.4. I told you write here, 2.6. Yeah. 24 minus 22.7. I get 1.3. Then I multiply by 2.6 times 0.4, getting 1.35. 1.352. The second one will be 14 minus 15.4, getting negative 1.4. And the second one will be negative 0.7. All right, times negative 1.4 times 0.5, getting 0.49. Then the other one will be 12 minus 15.4, getting negative 3.4. Then we have 21 minus 22.7, getting negative 1.7 times negative 3.4, getting 0.578. So what is the total here? 1.352 plus 0.49, right? Plus 0.578. I'm getting 2.42. That is what we are getting as our covariance. But what about these standard deviations? We say to the standard deviation is the root of variance. And to get our variance, right, of x, for example, to get the variance of x, I said we take the return of x minus the expected return of x squared. Then we multiply by probability. So the first one will be the return of x is 18 minus 15.4 squared. We multiply by the probability of 0.4. The other one will be 14 minus 15.4 squared times 0.5. Then the last one will be 12 minus 15.4 squared times 0.1. What is the total here? And in this case, I say 18 minus 15.4 squared. I multiply by 0.4, getting 2.704. The other one will be 14 minus 15.4 squared. Then I multiply by 0.5, getting 0.98. 12 minus 15.4 squared times 0.1, getting 1.156. What is the total? Plus 0.98 plus 2.704, getting 4.84. What is the root of that answer? 4.84. We're getting how much? Getting 2.2. You do the same for y. And we said to get this variance, I just copy this data I have here. That is where you see I'm not struggling here. So it will be 24 minus 22.7 squared times 0.4. The other one will be 22 minus 22.7 squared times 0.5. Then the last one, it is 21 minus 22.7 squared times 0.1. So how much is this? 24 minus 22.7 squared times 0.4, getting 0.676. 22 minus 22.7 squared times 0.5, getting 0.245. Then the last one would be 21 minus 22.7 squared. And I multiply by 0.1, getting 0.289. What is the total? Plus 0.245 plus 0.676, getting 1.21. What is the root here? The root of 1.21 to get to a standard deviation of y. So the root of answer, we get 1.1. Now, to be able to get your answer here, we are discussing about the correlation coefficient of xy. We are going to be taking 2.42, which is our covariance. You divide by 1.1 times 2.2, which you are getting 1. Which you are getting 1. Which you are getting 1. Then from there, the examiner might be asking you a very simple question. The portfolio risk. The examiner is asking you, what is the portfolio risk? And to ask us about the portfolio risk, we normally calculate the standard deviation of the portfolio. Right? You just need to calculate the standard deviation of the portfolio. And if we can be able to follow up formula here, we say, can we be able to take the root of the weight of x squared times the standard, the variance of x plus the weight of y squared times the variance of y, right? Plus 2, the weight of x, the weight of x, the weight of, what am I doing here? The weight of x, the weight of y, times covariance of xy, correct? Now, in this case, I'm just going to be taking a very simple roots. And our root will be, what will be our weight for x? I remember it was 0.2 squared times the variance of x, which is 2.42, plus the weight of y, which is 0.8 squared, times the variance of y, which is 1.21, plus 2 times 0.8 times 0.2 times the covariance here too. What was the covariance? We were able to get the covariance of 2.2. 2.42. This is wrong. What is the variance of this? This should be 4.84.
84.
Thank you. Thank you. So put it on your calculator. Okay, plus 2 times 0.8 times 0.2 times 2.42. Right? We are getting 1.74, the root of your answer, getting 1.32. Getting 1.32, right? Then the last question here. The examiner is asking you about the reduction in the risk diversification. And it is very important if we look on the weighted, because we say to get the percentage of risk diversification, we are going to be taking the weighted standard deviation of the portfolio minus what is our actual standard deviation of the portfolio. We divide by the weighted standard deviation of the portfolio, then we multiply by 100%. So what is the weighted standard deviation of the portfolio? We said we normally get it by taking the weight of x, we multiply by the standard deviation of x, plus the weight of y, we multiply by the standard deviation of y. The weight of x is 0.2. The standard deviation of x is 2.2. Plus the weight of y, which is 0.8, times the standard deviation of y, you are able to get 1.1. 1.1. So what you are getting here is 1.32. So when you take 1.32 minus 1.32 divided by 1.32, because the actual is what? 1.32. You multiply by 100 here. What you can be able to make as a decision, right? It means because the actual and the weighted are equal, the decision shall be, because here you cannot be able to find any change. There is no any change. So what you can be able to tell the examiner here, when you reach at that point, you can tell the examiner, the portfolio, right? You can talk about the portfolio formation does not change. The portfolio formation does not change. The portfolio formation does not change. The risk. This is because the portfolio is perfectly. The portfolio is perfectly positive correlated, right? The portfolio is positive. When you look at it, it is positive correlated. That it means it is +1. It means that is why you could see here that our correlation coefficient was equal to 1. The correlation coefficient was equivalent to 1. Now, before I do more questions there, I see people are suffering here because of VAT. Now, let me see whether I can do one question because I think the time is not on our side. And I'm expecting tomorrow we start exactly at 8 so that we can be able to brush up this portfolio theory and analysis. So that if we decide to have a makeup class, as some of you are requesting on Friday during our public holiday, then we can be able to start something different and fresh. Now, there is a question which they were able to test on May 20. I just want to take you slowly so that tomorrow I can be able to do 2 questions here. I do something called multi-factor models. Then we normally have another thing called the portfolio performance measures. Then we are done at dusting this thing. So let me see whether I can be able to do. It's very simple here. Sasa wacha tuifanye saa hii. And this one is different from what was tested last semester. So don't say mwalimu that umenifunza hii, so I can be able to do the last one. May 2021, there is a question there, question 2C. May 2021. May 2021, question 2C. FM. Someone to read very fast. Question number 2C here. Naona venye hata network leo ipotei. It seems that you are taking the topic very serious. Someone reads. A guy now should read for us now, unless we don't have one in class today. Bravo. Can you do it?
That's 3C. Zachary Mosomi, an investor, holds the following portfolio of 4 risky assets and a deposit in risk-free asset. He has provided the information below. You're given the assets, the weight, the current return, the beta, and the risk-free asset. The overall return on the market portfolio of risky assets is 11%. Required, requirement 1, portfolio return and beta. Requirement 2, using the results in Roman 1 above, deduce the type of investor Zachary is. Roman 3, using suitable computations, determine the assets that are inefficient, efficient, and super efficient. Roman 4, reflect the equilibrium for the portfolio.
Thank you so much. This question ikikuja namna hii is very simple. Examiner has given you the current returns, and then he has asked you to calculate the portfolio return and beta. That is very simple. Because you are going to be telling the examiner that you are going to be taking our weights. You are being given the weights there. You convert them. The weights, they're supposed to be in percent, in decimals. And then together with the, when you look on the aspect of the beta, we are going to be doing the same. These are free marks. So when this question is coming in your exam, this is what you do. This is what you do. This is what you do. Right. So now let us look on the question. We are being given the current returns, right? So I just need to take my current returns and multiply by weights. It is normally called the weighted return. So to get the first requirement, let us look on the weighted return, right? It is very simple because I'll be able to take 12 or 0.2 for the first times 12 plus the other one will be 18 times 0.1. Next metric should be giving me this answer. The other one will be 14 times 0.15 plus the other one will be 8 times 0.25 plus the last one will be 5 times 0.3. The weighted beta will be looking like what? The weighted beta will be 1.5 times 0.2 or 0.2 times 1.5 plus the other one is 2 times 0.1 plus the next one we have 1.2 times 0.15 plus the next one will be 0.9 times 0.25 plus 0 times 0.3. Someone to give me the answers?
The first one is 9.8.
90.
9.8.
9.8%. The second one? The second one? 0 points. Catherine? Zero points. Okay. No answer there. 0.2 times 1.5. 2 times 0.1. plus 1.2 times 0.15 plus 0.9. It should be 0.905. Then the next requirement you are being asked about was using deduce the type of investor, right? Number 2, you can just say Zachary is a risk averse. Zachary is a risk averse. Zachary is a risk averse investor. Since the portfolio portfolio beta, right, is less than 1. It is less than 1. You can see it is at minimum risk. That is, you can talk about the minimum risk. Number 3, examiner is asking you. Number 3, examiner using a suitable computation determines the assets that are inefficient, efficient, or super efficient. And in this case, when you are being given this problem, you come here, you tell us, let me take my assets, right? Then I can take my returns as provided. Then allow me to calculate the security market line. And what is important is to ask, what is a security market line? And I remember in our last time we talked about it. We said, what is a security market line? The last time we were here, we talked about the security market line. The security market line. So when you look at it, the security market line, we say, is a line drawn on the charts that serves as a graphical representation of the capital asset pricing model. So it is just like the capital market line is just like how we normally, and we drew. I remember we drew these graphs because we know that when we are measuring our risk, we normally use the CAPM, and it shows the different levels of systematic or market risk or various marketable securities plotted against the expected return of the entire market at any given time. And when you look, there is a question which they brought on 2022, December, right? So if we are going to be drawing the capital market line, let me just draw it here. Normally, it doesn't have the much difference. Let me talk about this, the security market line. The assets which, for example, are going to be falling. Let us talk about having the expected return of the market, right? So here we have the expected return of the market against the systematic risk here. The systematic risk, yeah? So what we are supposed to be understanding, the assets which fall along the capital market line, this is what we normally talk efficient. Or the assets are correctly valued. The assets which normally fall down here, these ones, we normally talk about the assets are already overvalued. Overvalued. Or that is why we normally talk about the inferior. But we normally have assets which are falling here, right? All these assets here is what we normally discuss about assets being undervalued. So when you are doing your computations here, you're not going to be using CAPM. We normally use SML, but the formula we use the one for CAPM. We say we normally take the risk-free rate of return, the expected return of the market, minus the risk-free rate of return, right? Then you multiply by beta coefficient. Then I just want to wrap this. Then at the end here, we are going to be having what? A comment. A comment here. I'm sorry, today I'm a bit fast because I just want to feel I'm a bit behind. So here we have A, B, C, D, and then we have something they are calling risk-free assets. So what are the returns as provided by the examiner there? So when you look on their current return, the examiner has already given us. So we have 12%, 18%. The other one is 14%. Where are we? Okay, 8%, and then we have 5%. Let us calculate the SML, and in this case, we just want to compare the SML against the returns. So let us look on the risk-free rate of return. I can see we are being given as 5, and which will be 5 throughout. Have you seen where 5 is? Ukiangalia swali yako umepewa hata hapa. So what is the expected return of the markets? The expected return of the market tumepewa ngapi? The overall return of the market is 11. So 11 minus 5, 11 minus 5. Sorry. The beta already provided here. So the examiner is giving you the beta coefficients. So how much is the beta? The beta we are being provided there. The first one tumepewa ngapi? 5. The first one umepewa 5. Let me see from my question. Is it 5? 1.5. This one is 2. The other one we are being given how much? The other one is 1.2. 0, sorry. 1.2, 0.9 and 0. So give your answers here, and then we provide a comment. I know this is 5%. Right? That is 5%. The difference is 6. So you just need to start with the first one. 6 times 1.5 plus 5. Getting 14%. Then the other one will be 6 times 2 plus 5. Getting 17%. Then the other one will be 6 times 1.2 plus 5. Getting 12.2. The last one will be 6, times 0.9 times, plus 5, getting 10.4. Do your comparison. When you look, for example, when your return and the SML are equal, we talk about a return, right, being when the expected return is equal to SML. This is what we talk about efficiency. This is efficiency, right? Then when you look on the expected return, is greater than the SML. The expected return is greater than the SML. We talk of super efficiency. Super efficient, and also this is greater than this, super efficient. Then here we discuss about when you see the SML is greater than this, we talk about inefficiency. Inefficient there, and also here we talk about inefficiency. Na hiyo ni kitu inakupea tu free marks there. Now, the last thing they were asking us about the equilibrium. And you say, at the point of equilibrium, At the point of equilibrium, we say the portfolio is correctly valued. And when you look at it here, on your comment section, which one is correctly valued? You can be able to tell us that the is correctly valued, hence efficiency. Hence efficiency. That is the portfolio return. The portfolio return is equal to 5% because the one is correctly valued. That is the one which is correctly valued. That is the one which is correctly valued. I will request now, if we don't have any question, if we can stop at that point and see each other tomorrow. Any question? Any question? Do you have question?
Mwalimu,
Yes.
will you share the recording immediately after class?
Yes. Just want even to upload it in a few.
Okay, then for tomorrow it's just a continuation. So could you give us like a recap of maybe what tomorrow you'll maybe teach? Maybe some notes, ndo tusome pia mbele.
Tomorrow we'll be able to do a question in December 2023. The question for portfolio theory.
For December 2023.
December 2023. There is a so not December, August, sorry. August 2023, there is a question there. For portfolio theory. Then I will be able to check on some whether I can be able to get some other 1 or 2 questions. Then after that, I will just be able to do multi-factor models. Multi-factor models. I will just be able, it is a very, took a small note, even a small half a page. I can be able to share with you. And then if we will be able to manage to finish it, then we should be able to do the portfolio performance measures. Are we together to that point?
Yeah, sure, yeah.
Yes, I will be able to appreciate if we can be able to finish up the portfolio question or portfolio topic this week, so that next week we can be able to work on a different topic and we work on clearing it, so that we can remain with only two topics now.
Sure.
Are we good?
Then Mwalimu, one more question for Friday, since you are planning on a makeup class, yeah, like you said, the way you were suggesting makeup classes for Friday. So maybe what time will it be, so that just in case CPO requires one for AFR, tumpe pia nafasi kidogo ndo zisicollide.